Well, good afternoon, investors. Welcome to our March 11th, almost St. Patrick's Day presentation of Bull Sessions. My name is Mark Robertson. I am joined here by my traveling desperado partner, Ken Kavula. And
I'm wide awake, ready to go today, Mark.
good, good. We are still struggling with what time it is, but that's natural at this time of year. And who knows? Maybe they'll pass legislation which uh, doesn't end all of this clock readjusting everywhere. We're also joined in the back room by Florida's own Kim Butcher. Good afternoon, Kim.
Hello, everybody. I hope you're having a good afternoon.
Now, Kim is back in her construction zone, so if she goes silent, you'll understand that's because of what's going on with her building right now.
Yeah.
And we're also joined by Matt Spielman. Spat, temperature check for Houston.
74 and sunny.
Uh-huh.
Well, we actually have sunshine today, Ken.
I know it's sunny and I think 45, so
It just means it's crisp.
yeah,
Getting
brisk.
Yeah, you can work outside and not break a sweat. So
All right, we're going to cover just a couple of topics. We're going to spend a fair amount of time with the Buttonwood Bulls portfolio and some rather assertive portfolio decisions. We'll spend just a moment with international stuff that's going on, thanks to Ben Carlson. And we will talk a little bit about we as road warriors have some expertise on rim wreckers and potholes. And I do apologize for the weapon. I guarantee you that is a plastic gun. It is not the real thing in my right hand. And, you know, we all know that the driver never would harm himself, you know, in that situation. So whatever. I barely even noticed it was there, but
Is this an AI creation that you did there, Mark, or is
it,
that?
it is. And
Uh-oh.
I was in my anti-radar mood at the time, so who knows? All right, this is your weekly reminder that Portillo's is not a sponsor of this session, although they should be. And that's a very recent article that Kim had mentioned perhaps previously about an activist firm in Chicago, Oakbrook, taking an even stronger interest in the company. And Kim, I'm pretty sure that, yeah, it actually says right there they nominated a couple of newcomers to the company's board. Are you tracking that?
I don't
I
know.
was, but I went.
Yes,
But I went and played in Vegas, so I got to get my head back the other way.
Okay. And there's the saws going in her building. All right. And then the picture on the right, again, more relish is better than more ketchup. So we'll talk more about that in the future. And it's still in kind of a turnaround pattern according to that point and figure chart. But we'll spend some more time on all of the stuff on the right side of that. Needless to say, we simply want higher prices.
Mark, what's on the ribbon in the middle between the two technical charts right there?
That's the Chaikin money flow, and that's a pretty decent
Okay.
indicator. It's money flowing into and out of the stock, basically, and
Okay.
you can see when it's being chased by more investors, the price goes up, and the opposite is true.
Carries the name of Mark Chaikin, right?
That's correct.
I'll give a free bit of advice to our entire audience. Don't get curious and sign up for the free information that Mark Chaikin is hawking on CNBC and a couple of the other financial channels. It is impossible to get him out of your email, and you get 8 or 10 of them a day. So just stay away from the Chaikin website, okay?
I made a similar mistake with something more closely related to swing trading or day trading, and oh my gosh, I'm still hitting unsubscribes and trying to get away from some of that stuff. Here is our disclaimer. First of all, we would never do that to you. We would not inundate you with all kinds of mail on a subject you don't want to hear about. But no investment here recommendation is intended here. This is entirely an educational demonstration. We are sharing the lessons learned by those of us that are part of the Modern Investment Club movement and the analysis and discovery and successful investing in general. So you'll hear opinions from us. Please do your own homework about any company being discussed, we will definitely be talking about real companies in real time here today. If we actually hold something in a real money portfolio beyond Buttonwood, we'll try to remember to do that to let you know that we actually own something, but it is all up to you. Share, learn, explore, and do all the stuff you need to do to make yourself a better investor. And you're on your own, but there's a lot of people here that would like to help you where you reach out and say, I need help with something. So please do that. If you'd like copies of the slides, or if you have questions or suggestions for future topics, our 2 email addresses are down at the bottom. Don't send me anything here over the next few days because the Big Ten tournament starts on Wednesday, Ken. And it's like wall to wall.
I didn't catch a big piece of it, Mark, but the little tiny piece that I caught showed Michigan State doing a job on Michigan. Did that continue for the rest of that game?
It
Yeah,
was closer, but they were not able to catch up. The first half pretty much set them in.
Well,
yeah.
I'm firmly in the green and white corners, so if they won, I'm very pleased. Okay.
They won. They won the Big Ten championship, regular season championship by 3 games. So,
All right.
in Michigan,
I hold Sparty in higher esteem than certain other schools, but I can root for Tom Izzo because he's been good for Flint.
yeah, he's been quite a coach. Here's just a glimpse of some of the stuff that's going on. It is a quarterly update for Home Depot right now. We'll do some Buttonwood stuff here, but just summarizing some of the stuff we covered on Saturday. James B. Clunan is the now deceased but former chairman of the American Association of Investors, and he likes simpler approaches better, and so do we. So we like to try to keep it as simple as possible. And Ken did his best not to break into calculus on Saturday morning, but
I've used this quote, Mark, over my teaching career in better investing and in other investing seminars. I've used this quote probably 40 times. I really enjoy this quote from Benjamin Graham, and I only tell them that the most complicated thing that they ever get involved with is semi-logarithmic graph paper, and they don't even have to understand anything about it other than it graphs in a straight line when the growth is reasonably consistent. That's the only extra kind of math you need to worry about.
yeah, I usually tell people that if they take a really close look at their value line company report page, that also uses semi-log paper.
Oh,
And
absolutely.
then they kind of calm down about it. Here's a look at the current condition of the market. You don't have to squint anymore to see that the most recent quarterly information on the far right of that graph, again represented by the value line arithmetic average, as the stock market is now definitely below the blue trend line. And that means that our return forecasts are creeping back up into low single digits. And in fact, value line went from 50 to 55, so they tacked on about 1% to their long-term forecast. So again, in that 10 or 11% range for forecasts. All right. Just wanted to spend a moment talking about a little bit of economics. Don't want to go too deep into this, but it's something that gets requested since we covered it a few years ago. This is from an interview by Barry Ritholtz, and he's talking to a technical analysis guru at the time. I'll show you more about that here in a minute, but he's basically talking about a presentation that this individual made. And he asked the class, which was a bunch of finance graduates and investing professionals, what percentage of stocks would you expect to be making new highs as the bull market hits its peak? You just kind of get a thought in your head, what would you expect? How many companies of the companies on the stock market would be making new highs as the bull market reaches its apex? Okay. And he said, well, what about 80%? And most of the hands go up in the class. And he said, well, 70, slightly less, 60, and he's working his way down, got it down to about 50. And by that point, all the hands in the class had gone up. Again, keep in mind, this is a room full of very, very smart people that work in the finance industry. And then he said, would you believe the answer is actually 6%? As the market reached its top, absolute peak, the number of stocks making new highs at that time was 6% on average. And I think that's pretty staggering. It's not what your intuition would take you there. I mean, I'd probably have gone as low as 20, but no lower than 20.
Well, and Mark, I want to give the room full of professionals their due. I think that it might have been a little bit of a trick question as well.
Mm-hmm.
When he's talking about a single day, I think a lot of them are really thinking during the time that you were moving towards the peak, and in that period of time. And on a single day, I can believe the 5, 6, 7% number because a lot of them are already sliding around that top number and have already peaked by that point. So yeah, I don't want to think they're all silly. I just think that
Oh, I'm not picking on them.
Oh, I'm not picking on him either, but I just think it's a little bit of a loaded question to ask,
You sound like somebody who has a skill set developed during your career of how to write survey questions, but we won't talk about that right now.
I think you can a lot of times get the answer you want by asking the right questions, okay?
And the reason he was talking about this with Barry Ritholtz was this is actually a charting technique put together by a Dr. Elder, where he says, okay, taking that thought and just comparing the number of new highs versus new lows, what type of picture do you get? This is the actual chart that would be current today. And if you want more on this subject, go to that link at the bottom there. That's the actual full interview where he explains the full concept. But what it comes down to is basically what he was saying. We like it in this form here. This is the one that we publish from time to time. Again, these are the new highs minus the new lows. So the new highs, working your way down the page, would be the green areas at the top of the chart. The ones where the net is a positive. So you can see we actually reached a relative long-term peak not that long ago. You can see that right over, let me get the highlighter. So it's a busy chart, but if you squint a little bit, I think you can get it. This new peak over here was not that long ago. And what I like to point out, again, just as what can this be? The times when there's more lows than new highs set, more new lows than new highs, you're going to have negative numbers. So these areas down below where it looks like that are kind of rough spots in the market. Now the background image that you can see down at the bottom, that light green area, that's actually the S&P 500 over time. So you can see the market fluctuation. So here is a really nasty time in the market. We know that is the financial crisis of 2007 to 2009. And, here's all that downward activity in this particular metric. Okay. The blue line through the middle of all that is the running average. It's an exponential moving average. So it's just kind of a form of smoothing. And as I look at this chart, I only become concerned at these points where it's kind of like breaking through and going negative. And when I say concerned, I just mean observed, very rarely ever big time concerned. Okay, so what I think I see when I look at this chart, first of all, the financial crisis was really nasty, and it was what you might call a rim wrecker. Just a really nasty period of almost 2 years when prices were really, really messed up. The other recent period, which was awfully nasty, was the COVID crisis of early 2020. And that actually has a bigger spike to the downside. Everything happened in a hurry, but began to recover pretty quickly and didn't linger so much like this here. This was a downdraft in stock prices that lasted for a very long time. So this one was more of a snapback rally with COVID, even though it was a really nasty period in the stock market historically, that sort of thing. So look at 2022. It was actually worse than most of us realized. That's a pretty good drop in the market during that time frame. But as you look at this chart, and this is what Dr. Elder is talking about using it for, he used different terminology, but anytime you get down close to a neutral position and you go through what might be described as a set of potholes, hence the pothole reference, when it turns back and goes the other way, it can be a very robust period following it. As you follow this chart all the way across, you can find those type of patterns any time that sets in. So again, these guys as technicians are basically trying to chart that. What does it have to say about today? I think we're probably in the middle of a snapback. I would call it almost a crevice. We're going through a period in time which is quite uncertain and disruptive, but I think it will be one of those where it's, if we're lucky, we'll just jump over it and press on and turn back the other way. That's just supposition. But here's what it's based on. This is from that Kramer book. Ken, do you remember we did that Kramer book review a little while back for better
Absolutely.
investing?
Yeah, it was we decided that if you could not listen to Kramer but read Kramer, you would believe that he was reading Nicholson. So it was
That's right.
a wide open moment.
Yeah, so this actually came from Kramer, and he's, you know, sometimes he just absolutely hits it out of the park. I'm not so sure about his quote last night, but basically what you're looking at here is employment. And a real recession is when employment is a problem. And that 2008, 2009, the red ticks are monthly downticks in employment or increasing unemployment, if you want to think of it that way. But look at that span from 11 up to 19 or 20. I mean, that was basically a march straight to the upside. And then what happened, and this is why I think of it as a snapback or a crevice or whatever you want. There's only two red ticks on here. And basically, if you really dug into it, and we talked about this back at the time, you could almost make a case that it wasn't real unemployment. A lot of the unemployed people were getting severance payments and other payments, you know, subsidies or whatever you want to call it. And I think we're headed for another one of those type moments, you know, right here somewhere. You know, as we have that dislocation in the job market, and it's none of it is good. I'm not for a heartbeat pretending that any of it's pleasant, good, or exaggerated or whatever. But some of these people get laid off and have checks for 6 or 9 months. That's different than being completely unemployed with no income next week. And so I think we're going to see a period where that combined with tariffs and other things causes a bit of a spike. So we'll see. Just Mark talking out loud. But then this one is the one that really clinches it, because you hear a lot of talk about fear of recession. What happens during a recession? The answer is basically your stock studies get messed up. Your stock selection guides get messed up. They got really messed up back in 2008, and they got messed up here too because of these disruptions in profitability. And pretty good picture longer term. It also gives you a look at the comparison of the different profitability levels. When you hear me talk about a metric being higher up the food chain, this is what I'm referring to. Net margin, of course, is earnings. Operating margin is something different. It's just what's left after paying the cost of goods and paying
I
your
think
people.
I think we should remind people, Mark, that back in COVID and back in 2008, 2009, we were trying to get the idea across that it was very difficult to recognize an outlier when it was happening. And when you look back historically, now you look back at your stock selection guides and you look back to the COVID years, you clearly see that in a lot of the measurements, the COVID year was an outlier for many companies. Not all, but for many companies.
For a lot of them. Yep, some
Yeah,
more than others.
and the same thing was happening back in the financial crisis. There were companies where you didn't see the financial crisis. There were more companies where you didn't see COVID, but the majority of companies had that aberration in the force, if you will. And it's very, very difficult to wrap your mind around the fact that what's happening today is something you're going to disregard 2 years from now. But I think that's the way you have to think if you're going to be a successful long-term investor.
Well, back in that 2020, plus or minus a year time frame, we did a presentation called Across the Chasm. And that's exactly what we were encouraging everybody to do, to envision, well, what happens, 2, maybe 3 years out from now for this company. And it can be a very powerful way to look at things. The other thing that we had a visual back then, you may remember this, Ken, some people abused us for this, but we had that rather rotund, robust fellow doing a cannonball into the swimming pool. And this is exactly what happened. I mean, there's your cannonball to the downside, and here's the tidal wave afterwards. So I don't want to say I told you so, but if you think about it from 35,000, I never recommend a cannonball from 35,000 feet, but from 35,000 feet, keep it in perspective. Look at what's happening on the other side of the chasm. This is a really good picture longer term for the economy. And you can see that both levels of profitability are in pretty good shape in that 3 to 5 year forecast.
I think the question that people that are in investment clubs that are running their own portfolios need to ask themselves a lot of times is, have I put together a study going forward that's a characteristic of what will be happening in the next 4 or 5 years and not just the next 4 or 5 months? I think it's really easy for folks to take some of the short-term pessimism that is built into a time like we're going through right now and try to extend it out for the next 4 or 5 years. And we need to bring that blue and pink chart back, Mark, where the upside of the market is there's so much more upside than there is downside to the markets. And if you're being too pessimistic on your studies, then you're showing all your stock studies to be buys or even sells, and that's not where you need to be at a time like this in the market.
Yeah, in fact, one last case study, and it's one that's becoming a bit infamous and notorious around here. Cy Lynch, in the middle of COVID, the worst part of COVID, selected Five Below. And we all were kind of horrified. At least I was. Maybe I was the only one. But I'm like, well, all their stores are closed. So I says, yeah, but they're going to open up again. And they can get through this. And when they open up again, they'll do just fine. And I can't do the Southern drawl, but, he basically said, you got to think about, out here, not what's happening at that time. So it was quite a moment. Pretty good selection in the history of the roundtable. All right. Unless you got anything else, Ken, should we just press on?
No, because I like what's happening in the next slide here, Mark.
Okay.
I think it's indicative of what begins to happen in more challenging markets. And in more challenging markets, our method of stock picking, our method of putting portfolios together usually results in relative returns that at least stay constant and sometimes even move towards higher numbers than you might expect. I guess it's a function of you're not chasing severely overvalued companies trying to keep up with the a reward that the market has given some companies that they are willing to take away as quickly when they lose the sense of optimism for what's going on. I mean, I don't think that the NVIDIA has changed in what its potential is or what the company can do or is doing and has done. I don't think any of that's changed in the last 3 months, but the stock price certainly has changed, and the
Mhm.
forward values for, that the stock market uses to value the company certainly has changed. And that's not true only for NVIDIA, but it's true for a lot of those companies at the top of our best 10 in the manifest universe right up there.
Mhm.
I mean,
Notice
we're
how,
seeing a re-ranking of those companies, but the relative return is staying in pretty good shape as far as I'm concerned.
yeah, Visa's keeping up pretty well. And I noticed you were trying very hard, and thank you for not picking on momentum too much, at least not yet. Because momentum, by the way, is the most devastated factor according to the quants right now.
It's
Anyway,
hard to keep your foot on the gas the entire trip, you
true.
know.
And Buttonwood Bulls, it hasn't actually been holding up pretty well. We told you that, and it's threatening to move up the list a little bit. So let's hope so. Let's keep going in that regard. Here's our quick check-in on the Groundhog Challenge, and we have a lot of opportunity unearthing here. Ken
We're
referred
getting
to
a
the
prod mark from Joe Whitaker, and it's the kind of prod that I think you need in a discussion like this occasionally, because I'm hearing it on television, I'm reading it in things that I'm reading, I'm getting the question being asked in groups that I speak to, and the question is this time different? And I don't think any of us have an answer for if this time is different. All I know is that if this time is significantly different, then we're going to need a whole new set of rules to deal with what we're talking about. And I don't happen to believe that this time is any more different. I happen to think that our government and our democracy and everything else has enough strength left in it to handle any kind of issues that we might have between the three branches. And I think that we're dynamic enough to handle any problems that the market might perceive and try to find ways to fix them. We're at least as capable as any other place that you can point to in the rest of the world, I think.
Yeah, no, I think that the question was also phrased from our audience on Saturday morning, Ken, where we were showing the quote by Warren Buffett where he said he could basically generate a 50% return back in the early days of his investing, or he still could. This was actually around a late 1980s or early 1990s interview with Business Week where he said 50%. And the audience said, is that still possible? There's less companies to invest in. There's, more algorithms going on, all that kind of stuff. And my answer, I still believe it to be true. First answer is, I don't know. Second part of the answer is, I don't think anybody has really put together strong evidence that proves that things are different enough to really affect that potential. So we promised that we would take a look at that for a future bull session. So that is on the list to my right now.
I really like to see Buttonwood moving up now, Mark, so that we're now in single negative digits. I don't like the red ink, but for a brand new portfolio, I think we're going to talk about it at length in a couple of minutes. For a brand new portfolio, I think it's beginning to do fairly decently, even in a very challenging moment where we started the portfolio. It's only down 2% right now, and I think that's pretty decent for basically picking 16 stocks all at
Well,
once and sticking them in the portfolio all at once.
well, plus my ideas or my nominations for today are like too good. What's not going to be not to like about them? So, um,
Oh, don't go there, okay?
all right, onward to our Groundhog Challenge. Here are the top 40. I have searched long and hard for my name and not found it. Buffett leads. That bunch of bandits out in the Heart of Illinois chapter have continued their stronghold on second place, the Breakfast Club. which I think is pretty interesting. And Ken, your Don Sheets is not going to be making your meetings any more comfortable.
No, he's not. He's in fourth place. I do notice that the number of clubs has declined. 1, 2, 3, 4, 5, 6, 7. I'm happy to see my family club making the top 40 there. But it's certainly interesting, to say the least, on what's going on right now.
Well, it's Kevin Gologlu's birthday tomorrow, so I had to sneak him on the list down there at 36. But
Are you telling me he's not really 36?
there's a remote chance. No, that
Okay.
he's earned all of that. He's
He
earned
is. Okay. All right.
it. And a lot of very familiar names over the years. Some community superstars on that list from top to bottom. But a lot of red ink over there. Ken tells me that that's not ballast; it's opportunity. So we'll continue to think of it that way. One thing there's a lot more of on this list. You may recall there were no celebrities in the top 40 last year. There's a lot of celebrities there now. Wow. And I have no idea
I don't know
who.
what that says, because it's early days.
Yeah.
If they're still there in December, then I think we need a session devoted just to that.
And Ken, I've been assured that Kolanovich thinks, whoever that is, thinks that the bottom for the momentum factor may be in sight. So that may also be a curse. Who knows? Let's go on to Buttonwood. Talk about this portfolio. This is the portfolio we started a little over a year ago. We've got a pretty good collection of stocks. We do want to talk about taking care of it. This is taking a look at the portfolio sorted from highest return forecast to lowest. The lowest return forecast we generally treat as a topic of discussion and perhaps debate, known as a challenge. You want to audit it. You want to say, what do we think about that particular company? It's a great company, Viva Systems, and it is on the hot seat this month. Anything else you see here, Ken, that you'd like to highlight, or still with us? I heard a bit of a click.
No, he's gone.
He's like gone?
No comment. Mr. Kavula has left the building.
He's not an attending anymore.
Not even offline, not even a ghost.
It probably means he not only forgot to set his clocks forward, but forgot to plug in his computer. In his absence, while he scrambles to be back with us, let me make sure he's not calling or anything here. Don't see anything yet. One of the things we talked about when we first got started, we wanted a portfolio of 16 plus or minus a few companies. I would like for us to lean towards the 12 to 16 range if we can over time. But we also talked about we want this growth number to be 13-ish or 14%. So far, we've been able to do that. We also want extremely good quality, and we would like to design the portfolio to be 5 percentage points ahead of the average forecast or median forecast. Well, right now that would require a 15.7% return. So this is a little bit light when it comes to the portfolio. The overall weighted average projected return of the portfolio is just a little bit light, but there is a fair amount of cash. So as we invest that, perhaps we fix that. Any sign of him yet?
I'm back. We had a power surge, and we lost power for about 10 seconds, and that cut everything out here. I don't know why it cut my computer out, but it did. So,
all right. So
I'm back. Okay.
we're pressing on. Now, I think Ty Hughes is in the audience. If he's here, he may have a word to say. This idea that we're going to borrow was actually inspired by Ty. So, Ty, do you have any comments on where you thought to do this? And I don't know if he's got microphone equipment or not. Anyhow, this is the question that Ty posed to Grok. Grok is the artificial intelligence engine on X, formerly known as Twitter. And I'm pretty sure this is the free part. Is that Ty with us?
Yeah, I'm with you. Yeah, so this was just kind of on a spur. I just thought I would try this on Grok. and it was really fascinating, you know, putting in the keywords, growth, fundamentals, return, forecast, and that. I think what these AI services do is they go out and they scrape the web and they gather information. And so when you have those keywords, it knows what to focus on. But what I thought was most interesting about Grok, when I went through it and then asked it to rank order, we took a look at our investment club portfolio for DC and said, okay, well, rank order these companies based on expected return for 2025. Now, I don't know how Grok knows, but it did. And then a related question was, which companies would you sell? And it gave me a list, and it said, when would you sell them? And then for the companies, it also said, well, wait and see if an earnings report. It gave conditions for the sale. And then another question is, well, give me a time sequence for selling. And it actually put periods of time, 1 week, you know, 1 day, 2 to 3 weeks, and then and with that, a condition to consider for the sale. Now, I don't know whether any of this is correct, except that when I looked at it, I said, you know, I don't necessarily disagree with anything here. And the interesting thing about Grok is that it's an Elon Musk company, and so because of that, they scrape in the old Twitter feed, now X, as part of the base. And as you know, there's a lot of back and forth on the market that shows up on X, so it's picking that up also. So anyway, I just think it was really cool, and the way it gave the answers, it was very, very readable.
Well, that's what we're going to look at that. We actually put in the companies for Buttonwood, and just for kicks, here was the result, Ty. I think I sent this to you, and we basically posed the same exact question to not only Grok but to Perplexity and to ChatGPT, just so we could compare them side by side. And similar to your experience, it's kind of a fascinating output. Again, the companies at the top would be companies you want to either hold on to or accumulate. The ones at the bottom might be flagged as consider selling. And Ken, you noticed some interesting characteristics here now that you're back with us.
I've had time to kind of play around with these and look at them and put them onto a spreadsheet and do some rankings and everything. Look at ACLS on the 3 lists and ask yourself the question, if there's a lot of reliability to these search engines, why are the answers so different? We're giving ACLS in 8th place, in last place, and in 6th place. Now, 2 out of 3 isn't bad, but why does Perplexity have it at the bottom down there? You know, I mean, we have Luminar in a number of different places in the portfolio, and that one seems to be pretty consistent, you know, 18, 15, 18. But there is a lot of movement. Mark reminded me who owns Grok. I think it's an Alphabet-owned company. Is that right, Mark?
That's no.
It's Elon Musk.
That would be Twitter. Yeah. No, but Alphabet is owned by ChatGPT.
ChatGPT is the Alphabet-owned company. Okay, so I wonder if that makes a difference in the wildly different placement of Alphabet on the 3 lists. I mean, first on 2 of the 3, and down in the middle on Perplexity down there. I just think that it points out the fact that we really need to get some information on what data was used to train some of these engines before we put a whole lot of weight behind what they're telling us as far as rankings are concerned. Right. I mean, are they relying on just scraping the internet? And if so, how much of this is based on technical data? How much of this is based on fundamental data? You know, and question after question after question. I don't want to make this simple for folks because I don't think it is simple at the moment.
Go ahead, Ty.
Let me offer a thought. I agree with everything you just said, Ken. You know, one thing you can do with these, I know you can do it with ChatGPT. When you get an answer, you can say, show me the sources.
Yes.
And it will show you which websites it's relying on. And Grok does the same thing. I haven't used Perplexity, so I can't speak to that. But I do know when I'm using ChatGPT for something that I'm interested in, I'll get the answer, and then the next step will be, well, show me the sources. And that's why I made the comment earlier. I think if Grok is pulling things off X, you know, the kind of investment folks that hang out on Twitter, you know, they're different than us. So that may explain some of the, some of the disparity here.
Yeah, they don't like Schlumberger very well at all. So yeah, interesting. So anyhow, I think the point here for somebody in the audience though is beware that there are biases still built in as these things continue to develop, and it doesn't hurt to do some cross-referencing. And as Ty said, take a look at what they're looking at and see if there's anything there that might introduce some irregularities or perhaps factors that we would consider less important, etc. So just be aware. All right. So basically, starting with that company Viva, that's the one that says it's probably worthy of a challenge. I look at Viva, great company. Um, this is a kind of a personal favorite of some of the clubs up in the Mid-Michigan area. So Ken, what are your overall thoughts on Viva?
I think it's a wonderful growth story. I think the consistency is exceptional, but I think it's the kind of company that the potential moving forward on a reasonable stock study is kind of lackluster. And Mark, when I do my own stock study on Viva and it sits on the pounce list in one of my clubs, I get a par value of just a little bit under 7%. I was happy to see that when I compared my par value to the par value on this particular study, you came up with a par value of within 0.3 of the number that I got on my study. That gives me some validation. It doesn't mean that either one of us is correct. It just means that we happen to agree with each other. My studies are based an awful lot on what I can glean off of the internet in relatively short amounts of time. I'm not a big fan of pouring in 2 or 3 hours on a stock study unless I'm to the point where I've narrowed it down to 1 or 2 companies, and now I have to actually put some real money behind it. So my stock studies are based on data that's easily available, and a lot of times that means Value Line, it means Morningstar, it means CFRA stuff. It means the stuff that's generally available to the investing public. I do have a couple of proprietary sources. I think Manifest is a proprietary source, and I have one source that I get off of one of my broker sites. But they seem to all validate this Viva study, Mark, of somewhere between 5.5 and maybe at the outside 8.5 par value.
Yeah, and I look at it and I reach some of very similar conclusions. I mean, the company is maturing. It's growing. It's been wonderfully successful. But this number here, the return forecast, is at a multi-year low. It's not tragic, but it's between money market rates and my par, so it's down in that range. The one thing that does bother me a little bit is I would love to see Value Line's next forecast, because that's looking like an ugly number out in the 3 to 5 year forecast. And I also noticed that the price range expected in the long-term forecast has ticked downward instead of upward. We like upward better. The other thing that I would point out, that in order to achieve this 6% return, they need a PE in the 30s. And that's a little bit frothy. So again, great company, maybe just a tad bit on the overpriced side. In a different portfolio, probably a stronger hold. But in this case, it is our weakest par. Here's a look at some of the other activity. Again, I start to get a little bit nervous about expecting a PE above where it is now, based on the picture we've seen.
Mark, could you back up one thing? I've had a note in front of me from 3 different people for 2 different months, and I've promised I was going to tell you about it, and I never have.
Oh no,
Would
here
it
we
be?
go.
What's no big deal, but would it be possible on this format? I know it's a format that you use all the time. Down on that line about PE ratio, to put the word average between projected and PE. because that is important to a lot of folks out there, that you're using
Right
an
here.
average. Yeah, put it right there.
Okay.
That you're using an average PE, and I've just been remiss
Okay.
in
Done.
transmitting that piece of information to you, and I've had it sitting here for at least 3 weeks, if not longer. So
Consider it done. So the
great.
price that it's at is sitting at a relative high for the year. Also, it's up near overbought. So again, it just kind of falls into that mode of it's not a screaming sell by any stretch of the imagination, but these numbers are not real strong. Um, again, as far as return outlook, everything else looks pretty good.
Well, then we should go back to rule 1 for when to sell, according to the to George Nicholson. And as far as I'm concerned, there is only one rule. And when do you sell? When you can make the portfolio better. And I think we can find a company to replace Viva with that will make the portfolio better.
Mm-hmm. Here's some of that verbiage that Ty was talking about. They're basically kicking back some of the findings right here for Viva. And that alone is a kind of an instant stock report for sure. All right, so here's the portfolio again, and we're going to look at it in terms of what should we do. These are sorted from largest holding to smallest holding, and Viva is right here at that 6.4. Again, as we mentioned a little bit earlier, the growth is fine, the quality is fine, but we would like to drive up that 13% a little bit higher. And the way we do that is by replacing companies with lower return forecasts with companies with higher forecast. The other thing that we're going to do is, since Ken is losing sleep at night over the presence of a speculative stock in the portfolio, and I'll tell you a little bit of secret. My wife's name is on this portfolio, so she kind of considers this to be her own money. And she doesn't like companies without earnings either. She's listened to Ken far too closely over the years, and I'm doing all I can to get her a little bit crazy. But there you got it. She says if it doesn't have earnings, maybe we need to wait on it. So we are aware that there's an event coming in a few days, which means the price will probably double if we were to sell it here today after 320, but that's a risk of being alive. So the first thing we're going to consider doing, Ken, if you approve, is to take this 3% of the portfolio and basically set it aside on the worksheet.
I have absolutely no problem with doing that with those two stocks, Mark. The only thing I ask is that we look to replace them with stocks that have a robust par. We're taking the saving grace of these two stocks are the par values attached to them.
Absolutely.
So when we're going to replace them, I don't think we have to match them exactly, but I would like to see at least 14-15% par as we move to replace them.
Mm-hmm. And so you get the final vote on Salviva. Do we dispense with that one also? And
I think
$200?
I think in the beginning of creating a portfolio, when you've just kind of put 16 stocks in there, I think that trading like we're doing right now is probably going to be much more frequent than after you kind of end up with some stocks you can begin to trust and follow. So I like Viva an awful lot. I might have even brought the name to Buttonwood for us to consider, but I think we can do better with par. And at 6.4, it's the lowest par. So let's take that $217 and make the portfolio better if we can.
Okay, so what we're basically describing is we're whittling away the smaller positions, the lowest return position, and we're going to replace 3 stocks with 1, maybe 4 stocks with 1, depending on how the next discussion goes. But again, we want to keep it in that 16 total stocks range, plus or minus. I can't imagine that we'll be able to. I think 20 is probably our upper limit, and we'll probably drift back to that over time. If I had to think about 2 years from now, it'll be hard to keep it down below that. But for now, we want to kind of hover around 16. And my suggestion is these are 3 companies that are in the semiconductor field down here. One of them is an active position, ACMR Research. It is also a fairly small position. It's a good company. There's nothing wrong with this one, but just wondering if we might not be, again, in a 16 stock portfolio, we don't need 2 or 3 semiconductor related companies, is my opinion. And I'm going to suggest that we consider replacing AMCR and, of course, Axcelis already with Taiwan Semi because of the strong characteristics. Now, Ken also wanted to compare side by side ASML. So, Ken, what are your thoughts on ASML?
Well, ASML's in the same industry as ACMR. In fact, it's a stock tickers that get mixed up by members in our community a lot of times, which is which. ASML basically is a company. It's a Dutch company, and it is used by every single semiconductor manufacturing company in the world. They basically have figured out ways to print the circuits in 3D on these wafer chips, and that kind of technology is needed for these very complicated chips that are being made. So ASML doesn't produce the chips, but they certainly produce machines that are then used by companies like Taiwan Semi and some of the other foundry companies. Those machines are used to do printing of the circuits on silicon in 3 dimensions and on very small pieces, very microscopic pieces of silicon to make it all fit together. The only thing that I think it's fair for us to bring up and talk about for just a moment with Taiwan Semi is its location. And I don't know whether the argument that says Taiwan Semi is probably reasonably safe from mainland China, because mainland China, one of the last things it wants to do is upset one of the major industries that it would maybe acquire if it were to invade the island of Taiwan. Now that assumes rationality among all the leadership that's involved, and that's not always the case. We've been through a lot of problems in the world over history with leaders that are irrational. So I just think it's fair for us to ask ourselves the question, are we going to put a huge amount of money into Taiwan Semi? I would not want to see it become something that occupies 20 or 30% of the portfolio, but at a normal percentage of the portfolio, I think there's a place for Taiwan Semi in anybody's portfolio. So with, what do we have, 15, 16 stocks? So that's about maybe 7% for
7%. Yeah.
Normal holding. So, bringing it up to 6 or 7%, I'd be very much in favor of it or ASML. I think they're very similar companies. Mark has made the point that maybe Europe is just as dangerous as Taiwan is at the moment, and I don't know if I'd go that far, but at the same time, there are some problems with the Eurozone and with everything that's happening. We've been made very aware of the fact that some of the European countries don't have their defenses at a suitable portion of their budget, and that impacts the companies. And we understand that tariffs are cut both ways, and laws are different and regulations are different. But all in all, I can agree with everything you have on there, as long as we acknowledge the fact that Taiwan Semi is in a very a place that I wish it wasn't located. I'm happy to see it investing large amounts of money in the United States and helping Intel to come up with manufacturing expertise and bringing some of that back to our country. But it does exist in a very hot spot in the world's today.
Okay, so I think I would go ahead and substitute the Taiwan for the other, and hope that we don't have a geopolitical situation there. we've been living with that with nice and in mode for far too long
And
now.
then you've done exactly what we need to do with URI and NAVO. You've looked at for two stocks that beat the average that we have in the portfolio right now, which is 13, and that's the way you raise it. You raise it by buying stocks with higher par values.
And
So we traded out some pars that were pretty nice, but we didn't suffer with the par when in the trade. So that's good.
and you guys are going to like this one, even though it's an amendment to our operating rules, but it was done by my boss, who I live with. She basically said we were talking about this portfolio, and she said, "Well, isn't blood kind of running in the streets?" And I don't mean to be too, crude about it, but isn't the stock market getting killed? And I said, well, yeah, the market is definitely getting abused, maybe not murdered, but getting abused. She says, well, let's put more money in then. So what she wants to do is, I'm not kidding, Ken, she wants to invest more when my par is in double digits. Now, I think that counts as somebody who's paying attention. So
Well,
she
it
actually,
counts as somebody paying attention as long as the increase is not excessive compared to the portfolio. I
right.
would tend to agree with her. If Wendy would have turned around and said, "Let's add another $4,000 to this relatively modest portfolio," I would have a discussion with her about that. But an extra couple of hundred, I don't see
Yeah.
anything wrong with that.
Well, she was having those thoughts around Luminar, but just kidding, just kidding. All right, so let's go ahead and demonstrate. We did look outside the portfolio for anything that's off the charts, decent returns, excellent quality, double-digit growth, beat up, and you come up with some interesting, including one that's already there. So there you have it. Let's go ahead and make those changes and demonstrate it in the actual portfolio itself. Let me try to boost this up a bit, Ken. Tell me when it's somewhat legible.
We're there. It can be read now.
Okay, so we'll go into the worksheet by doing the pull down tab. Go into the worksheet. And I think this is the most recent version, so you will see ASML along with others. We're going to put Luminar down below.
Mark, can I talk about a best practices when you're doing a worksheet?
Sure.
This has nothing to do with managing the portfolio, but I like to tell everybody in my clubs, and we use these worksheets all the time, to always, when you open a new worksheet, to reset it so that you're absolutely positive it matches what you had in the original worksheet. And that's just a matter of pressing that reset button and waiting for a second while it resets to match what was in the original worksheet. Once you're there, then you're sure you're starting with a nice new worksheet. And that, I think, is just best practices when you're dealing with manifest. That's all.
Okay, and then we had also decided that we could discharge ACM research. And we can also set aside ASML for now, keeping that in on our radar screen. And when it comes to Taiwan semi, we had decided that we could we said $250. Where's my calculator? We'll just round it off for now. $250 into it at 170.65.
1.5.
So 1.46.
All right.
Says the math teacher.
Yeah. While you're doing that, Ty, if you unmute yourself, we'll take your comment.
That may have been from before when he was trying to get our attention.
Okay, there. No, now we're both unmuted. Go ahead, Ty.
Just had a question on the green down arrow versus the X. When you're doing a what if on a spreadsheet, you mostly just use the green arrow, so you save it in the inactive as opposed to the red X, which I think deletes it completely.
Right, and a lot of clubs, what they will do is go through the motions of what we're doing now. Using the green arrows just sets it aside. It corrects the cash balance, obviously, but you can put it back. But this would be for purposes of proposing the sale of the companies that show up at the bottom, and basically ending with the companies up at the top.
Ty, we find it very, very helpful to use the green arrow most of the time to make it inactive, because a lot of times we don't take individual motions because we find that they're very fluid when you're playing this game. So we kind of dissolve into a committee of the whole and let people make suggestions and play with this worksheet, moving them up and down and up and down. And the green arrow accomplishes that. The only time we use a red arrow is when everybody is convinced that one's leaving the portfolio, and then we just exit out. But that doesn't happen very often. So that green arrow is very helpful, especially when somebody a lot of times starts out by let's sell the whole thing and see what happens, and we end up by selling a third or a half of it rather than the whole thing.
I got it. Thank you. Thank you very much.
Okay, so we've got money to add de novo. Should be, we're basically taking and adding a little bit more to novo to get it up to a full position like Ken was talking, you know, that 6 to 8% range here. And the other one was United Rentals, which we basically want to do the same thing and take that up to a position closer to a full position. We've still got plenty of money to spend, Ken, so we'll have to go shopping next month.
Okay, that's okay by me. I think that we're demonstrating what's a good word, Mark, for not blowing it up, but being aggressive enough. Maybe that's it right there. We're being aggressive enough for today without having to feel we have to spend every single dime that we have available. We're keeping some of the powder dry.
Yeah, we could very easily add to Texas or United Health, but they are not in the sweet spot. And I would say just kind of let it ride, and we'll talk about buying $400 worth of Bitcoin next month instead. No, just kidding. Just kidding.
The other thing, Mark, that we do sitting in the clubs that I belong to is we always tend to look at this portfolio when we're playing with it, and we're sorting it by par a lot of times. And why don't you demonstrate how easy it is to sort this thing by any of the columns?
Yeah,
you know, you just click on it. Just click on it. It's all you have to do.
and that place is, you know, again, United, Green Brick up at the top by par. So if we held that gun from the cover slide to my head and said, Mark, you have to invest in another company, I would be shopping up here at the top of the list. I would probably perhaps trickle some money into Western Alliance, maybe a little bit more into Novo. Taiwan, maybe a little bit more than we originally put in, but you get the idea. You can
well, and even Raymond James, which is just a nudge off of the sweet spot. I mean, it's 2/10 off the sweet spot. So even Raymond James might be a candidate for a little bit more money as we're talking about it. Well, for that matter, maybe even United Health Group.
Let's do it, Ken.
Pardon?
Let's do it. We're going for just a tiny bit more Raymond James. Doesn't overpower the position. What was your other one?
United Health. I think I really have been, well, I shouldn't let my personal investments trigger this, but I really thought that United Health took an unnecessary hit, and that it's an extremely buyable company right now.
What's not to like? All right, just that's small. We just trickled a little more money into a couple of those two favorite positions. Please notice that the par has now reached 14.4. We could go a little bit higher, but let's think about it for a month. Let's go out.
I think what's important, Mark, to point out to people that don't use this worksheet is that you're taking money that is in the portfolio at 5% par, and you're putting it into stocks that are at double-digit par, and that's why you can move that number in a smaller portfolio relatively quickly.
I'm going to take a picture of that, put it in the forum for anybody who wants to come back and look at it. We'll do that. And then what we're going to do is save to original, which will discard all that stuff at the bottom. And the new portfolio is saved here into the original slot with the modifications. Okay.
It'd be interesting for me, Mark, just for you to roll down a little bit and look at the diversification by size picture. I just would like to get a rough. That's what I thought it would look like. Okay, all right.
Well, we're trying to keep that number at 13 or 14, so it's up there.
Yeah, this is, folks, this is a fairly aggressive portfolio. When you're aiming at 13, 14% growth, sales growth, that's a pretty aggressive portfolio to put together.
In fact, I would hazard a guess that our next move will be to reach for even more growth, hopefully finding a good candidate in the upper teens to keep this number high enough. Anyhow, all right, so we'll switch back to the presentation. Are we back at my screen, full screen?
Yes, we are. Full screen. Is international diversification finally working?
Just one more, I don't want to say nail in the coffin, but just pointing out that something has changed. And Ty Hughes, we did talk about, now, does this have any ramifications for the government savings plan, the retirement plan for government workers, because we were kind of nasty about the international option. Maybe we come back and talk about that at a future session, but it's always been quite a disappointing option for that particular plan. And those mutual funds on the lower left, they're not part of this article. It's just what has happened. I actually had an investment in Artisan International. So again, all of those underperformed, and those other two are Ken's.
And the first two are the only mutual funds that I still own. So you can see the relative return, folks. Okay.
Yeah. And Ben just simply makes the point and asks the question. So Europe and China are doing pretty good right now. Will it continue? It could. It hasn't for quite a while, but it could. All right. One last thing for everybody. We do talk about Tom Lee quite a bit. There's a great interview on the compound from last Friday where Tom basically says, everybody calm down. The market's only gone down single digits. We're only now at the cusp of 10%. And he continues to be very optimistic. On the lower right are the absolute new additions to his Granny Shots exchange traded fund. So those are there just for your information. We might take a closer look at all 6 of those. A couple of them are kind of frisky.
That's the understatement of the bull session, Mark. Okay.
Well, you got to. Kim has.
You gotta take the truth, and it's kind of like they're frisky with a little bit of coin involved.
Absolutely. All right, so here is actually the Freakonomics session that Matt mentioned last week, and you can actually go find them at that URL down at the lower left. And it's definitely a worthy topic if you are looking at Warby Parker. So with that, we'll go ahead and close down by reminding everybody that we do archive these sessions. Ken and I got to do last week's again because I hit the wrong button a week ago. So that's why it says take 2, and it's slightly different, but we basically ended up doing a very similar program for purposes of keeping the YouTube string intact. It was the first time we had made that mistake. I'm including you now, Ken.
Thank you.
And then last but not least, in case you missed the news, Parker Brothers, actually it's Hasbro now, is out with a cashless version of Monopoly, which I find fascinating, and it's going to be even more fascinating to listen to the irate parents and teachers.
I will tell you, Mark, that I read a balancing article about this, that Hasbro was going out of its way to let people know that the original game was not disappearing. This was just an additional game you could purchase if you chose to. So We don't have to go to an app with no money anymore. You still can hold that money in your hand. There's still that gold $500 bill is still there.
And I don't know what the little crown pieces are or whatever, and just give me my Scottish Terrier and I'll be happy, or my railroad car, whatever. So with that, I think we're out of time. Send us your thoughts and questions and future topics. We'll answer that Buffett question, and we'll take a look at a number of things. Ken had asked how many companies are in value line without earnings. We'll answer that question next week, and maybe even take a look at Costco.
Hey, before we sign off, Mark, Ty has his hand up again. Ty, go on.
Sorry, Ken, that was an inadvertent hand up. Let me
An
put it down.
inadvertent hand. Okay.
But I will say, actually, I will say two things. For our investment club tonight, we were looking for the difference on the international, and they have caught up. International's caught up. It's up almost 8%, while the market was down 5 or 6. The U.S. market. That's an interesting fact. And then it also looks like today the indices are about even. They were down early and they're coming even. So who knows where we're going, but it's not all doom and gloom. Doom and gloom. That's all. Thank you.
That's a good way to end the bull session, Mark, with something optimistic. Okay.
Absolutely. Well, thanks, Ken, and thank you, Ty, for the inspiration. And we'll be back next week with a few more things to kick around. Thanks, everybody. Take care.
Good afternoon, everybody.